Hello everyone! Today, we're tackling the constant growth dividend discount model, an essential tool for valuing companies which have reached a stage of stable growth. These calculations are actually very simple. Acquainting with the one-step approach will be helpful as you continue diving into other more complex forms of the dividend discount model. For instance, we will often work in the valuation of stocks which are still in a period of accelerated growth, and we will instead need to rely on a two-step model, which you can learn step by step in a different video. For now, let us focus on the constant growth version of the DDM. Imagine we're analyzing a company called Basic Innovations. The company has been in the market for nearly 40 years, and its revenues and earnings are already growing at a slow but steady, positive rate. Here's the data we'll work with. The company's last dividend, D0, was $2. Keep in mind that D0 is the last dividend paid by the firm. We only use this value to calculate D1, which is the first dividend we expect in the future. If D1 is already given in evaluation problem details, you would not need D0 at all. Intuitively, a stock valuation only considers the cash flows or dividends an investor will receive after buying a stock. D0 was already paid, and a new investor would not receive it. For this reason, this dividend and any other past dividend is irrelevant for valuation purposes. Basic's dividends are expected to grow at a rate of 4%, which is considered as its long-term growth rate. The required rate of return, which we calculate using the CIPM, is 10%. Our task is to calculate the intrinsic value of Basic stock using this information. Keep in mind that we are dealing with some limitations. First, if the stable growth rate, G2, is higher than the KPM rate, we would not be able to use this valuation model. Needless to say, the dividend discount model is appropriate when firms consistently pay dividends and when dividends are moving in tandem with earnings. Next, we calculate the stock value. In other words, if you sell the stock today, this is the amount you would receive, which represents the value of all dividends an investor expects to receive if holding this stock forever. To do this, we use the formula: the stock value equals the expected future dividend by the end of the fiscal period, divided by the difference between the required rate of return and the long-term growth rate. Since we are not given the expected dividend, we instead estimate it ourselves by multiplying the last dividend paid, which is D0, by 1 plus the long-term growth rate, which is 4%. Substituting the numbers, the stock value equals $2 multiplied by 1.04, and then divided by 0.10 minus 0.04. That's $2.08 divided by 0.06, which equals $34.67. The value obtained from this formula is the result of a geometric series, which is essentially the sum of the present value of future dividends, 1, 2, 3, and all other future dividends forever. As long as we expect Basic Innovations dividends to grow at a 4% rate for the foreseeable future, and the CAPM rate is correctly estimated, the value of Basic's shares is $34.67. Based on the dividend discount model, if the market price is below this value, it could be a great buying opportunity. If it's above, you might want to reevaluate. And that's it. We are done for now. Keep up the great work, and I'll see you next time.